Bank of Canada did increase their interest rate again, putting it now at 5%, the highest it's been in 22 years. And I think the real question that everybody has is this the end? Is this the final rate hike before we could see rate climbs settle down? This is the 10th interest rate rise that we've seen since interest rates started to rise in March of 2022. And yet, out of all of the rate increases that we've seen, this should be the one that people are least surprised about. I mean, when the Bank of Canada increased their interest rates in June, they were clearly and loudly communicating to the market that this battle against inflation wasn't done yet. And they weren't just increasing the interest rates by 0.25%. No, more importantly, they were breaking a rate hike pause. And they're not going to do that for just one single rate hike. I mean, is 0.25% really enough to do anything in the market? In the grand scheme of things, it isn't. The real question is, 0.5% enough? The Bank of Canada did indicate to the markets that they are prepared to raise rates further, saying that if they don't do enough now, that they're probably going to have to do significantly more later. But the Governing Council did discuss the possibility of keeping the rates the same this July, ultimately deciding though that the cost of delaying the rate increase was more than the benefit of waiting, saying that they were concerned that if they were not careful, the progress to price stability could stall. And I think this is where the Bank of Canada really shows that it's somewhat cautiously optimistic, saying that because of these rate hikes in June and July and all the previous rate hikes that we've gone through, that enough of that will play into the market that we'll see inflation come back down to the 2% target sometime by 2025. But they also put that tiny little asterisk on it that says that if the market doesn't behave or respond in the way that they want it to, that they're not afraid to do more. And we've seen that play out before, where the market started to anticipate some kind of rate decrease, and as a result, their consumer behavior changed, somewhat fueling more inflation. So if that happens again, the Bank of Canada will step in to make sure that everyone knows that rate hikes are still on the table. So the Bank of Canada hasn't said that they will not raise rates, but they also haven't said that they will not raise rates. Now, if you look at the predictions by the economists of the big banks, a lot of them have said that the Bank of Canada has priced in everything that they're going to price in, and that you're not going to see a key interest rate rise higher than 5% by the end of 2023. Going so far as to say that by the end of 2024, interest rates will have dropped by somewhere in the neighborhood of 1 to 1.5%. But that's only if the market behaves. And speaking of behaving, the Bank of Canada did say something in their statement that I think a lot of people are either going to miss or misunderstand. The Bank of Canada said that the Governing Council will continue to assess the dynamics of core inflation and the outlook for CPI inflation. In particular, we will be evaluating whether the evolution of excess demand, inflation expectations, wage growth, and corporate pricing behavior are consistent with achieving the inflation target. And now there is something that we haven't heard before from the Bank of Canada: corporate pricing behavior. Essentially, what the Bank of Canada is saying is that they're going to be actively monitoring and looking at whether the pricing behavior of corporations has had an impact on driving inflation up. Now, they're not saying that corporations have actively taken a part of price gouging, or as some people are starting to call it, greedflation, but they are saying that they're starting to look more closely at it. And it'll be interesting to see what their reports start to find as they look more into that. For now, though, the rest of us are stuck dealing with the consequences of yet another interest rate hike. For variable rate holders, this means that the policy rate is now over 7% for the first time in a very, very, very long time, meaning that all variable rate mortgages are now going to be over 6%. And given that 1 and 2 year fixed mortgages are still hovering in the high 6s, and fixed rate mortgages for 5-year products sitting somewhere in the 5.5% range, it means that the yield curve is most definitely still inverted, and that, at least statistically speaking, we're bound head on for some kind of recessionary environment.